Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome once again to another episode of Pasture to Pin, a bi-weekly series from the EverAg Insights team. Each episode, we bring you news and updates on the markets with the intention of helping cattle producers manage their risk. I am your host, Michael Todd Rowen, coming to you from my home office in the Texas Panhandle. Before we get rolling, let me timestamp this episode. Today is Tuesday, October 17th, 2023 at 3:13 in the afternoon. Today, we will welcome back the newlywed and my compadre on the cattle trail, Mr. Trey Freeman. Trey, congratulations again and welcome back to the show.
Good to be here again, MT.
We are happy to have you. Kicking us off with weather, we have clear skies for most of cattle country this week. 5-day forecast, however, looks a little promising for small showers in the Corn Belt, as well as parts of the northern plains. There have been some changes in pasture conditions for certain parts of the western United States. Nebraska is much improved overall, while there is still some lingering drought in the eastern part of the state. The rest of the state has seen drought conditions ease and pasture conditions improve. However, for Texas, Louisiana, and other Gulf states, drought continues to plague not just pasture conditions, but the entire state. The same is true for parts of Kansas, Missouri, Iowa, and then on up into the Pacific Northwest. Switching to the cash market, the CME Feeder Cattle Index 7-day average slipped lower last week, falling $1.53, ending Friday the 13th at $248.26. down from $249.73 the previous week. In the sale barn, demand remains good to moderate as supplies continue to dwindle. Sale weight mixes have seemed to shift. Earlier this month, 50% or more of sale weights were above 600 pounds. Now that mix has flipped, where most sale weights are below 600 pounds, speaking to the dwindling supply of feeder cattle. On the live cattle side of the market, last week saw sales top in Iowa at 187 live. Most sales were a few dollars lower than that 187 mark. The bulk of the sales were at 183 to 184 for the north and the south. That north-south spread is almost gone outside of a few sales in the north. This is typical as we get closer to winter, which is much harsher in the northern plains than it is on the southern plains. Boxed beef prices continue to impress. Choice jumped $3.87 yesterday to $304.67, up from $302.62 since just the last episode. Select was also up $1.71, settling at $277.20. This is up from $276.75 since the last episode. Before we dive into futures, let me bring Trey back in for a quick segment of Coffee Shop Talk. Trey, what are you hearing from out in the field?
Well underway in the corn harvest here. Pretty good yield so far. We're in irrigated country, so, we have guys shooting for 230 to 300, but overall pretty average. Everything's going well there. Other than that, it's just maybe football. Oklahoma and Oklahoma State football.
Yes, sir. I hear you. I'm glad to see y'all are in the win column because Texas Tech football is not. So anyway, around the Amarillo area, temps are getting cooler. Wheat is getting planted. Calves are hitting the grow yard, and PRF sign-up season is well underway. Just as a reminder for our viewers, the PRF window opened up in September and will close December 1st. Trey, let me toss it back to you. Take us through a futures market update as well as a deep dive into the technical aspect of feeder and live cattle futures.
You bet. We'll begin with feeders and use the most active January contract, currently trading at 252.80. First level of resistance above the market is the 50-day moving average, currently at 256.50. Reach above this opens the door to the 20-day moving average, currently at 257. And then psychological resistance at 260. It's been 2 weeks since January has closed above these two moving averages. The longer it fails to close above these, the stronger the resistance they become. Chart pattern I'm watching closely in the January contract is the relationship between the 20 and 50-day moving averages. Anytime you have a shorter term moving average cross below a longer-term moving average, it can signal the exhaustion of upward momentum. The 20-day at 257 is quickly encroaching on the 50-day at 256.50. So should it cross below, watch for sellers to enter the market and potentially another leg lower. Support below sits on the 100-day moving average, currently at 251.40. Close below opens the door down to the July low of 245.30, and then to the gap left hanging on the chart from late June between about 242 and 243. Charts like to fill gaps, so a move down to that July low of 245 may make price gravitate to that gap area. Looking at a seasonal pattern, January feeders tend to trade sideways into the 1st of December before posing a slight rally into the 1st of January and followed by a drop into the expiration of the contract. Moving on to live cattle, we'll be looking at the most active December contract trading at 186.87. The first level of resistance above the market is the 20-day moving average at 187.80, just $1 above today's close. And next is the contract high of 192.05 from last month. Support below the market sits at the 50-day moving average of 186.70. This has been an area of attraction over the last 2 weeks. We managed to close over it today, but I'd like to see confirmation with the close above it again tomorrow. Next level of support below the market is last week's low of 184.25 and major support at the August low of 181.92. Now, a technical indicator I like to watch in live cattle is Keltner channel. This is a volatility-based indicator and can assist in identifying trend direction. The channel consists of a middle line representing the exponential moving average and one band above and one band below. These bands will swell and contract with volatility. Since early May of this year, price has traded mostly between the middle moving average line and the upper band, often hugging the upper band or sometimes trading above it for consecutive days, as breaks above this signal continuation of the uptrend. However, since the downturn from the contract high last month, although prices have shifted to trading below that middle moving average line, they have yet to flirt with that lower band. This tells me downward momentum has yet to turn too heavily to make much of a case for the bears. Should prices begin to flirt with that lower band after hugging the upper band for most of the year, the trend could move further in favor of the bears for a more prolonged period. I use a Keltner with a length of 20 and a multiplier of 2 if anyone wants to pull it up on their chart. Looking at the seasonal pattern for December, we tend to have a moderate rally into late November, followed by a sharp decline before bottoming around December 10th. Moving on to managed money in live cattle. Managed money has lightened their net long position by almost 20,000 contracts over the last 3 weeks, with the latest CFTC Commitment to Traders report showing a net long position of 80,000 contracts, likely making the funds the main perpetrator of the recent downturn. I'd attribute this long liquidation of funds to the prospect of higher interest rates. We've seen strong treasury yields along with strength in the U.S. dollar and overall just recession fears that continue to plague the market. So what's all this mean? What's the big picture on the charts? What do they look like moving forward in the cattle complex? Taking a step back and looking at the historical gains we have posted throughout the last couple of years, the recent near $20 hundredweight move lower from record highs in feeders and $8 a hundredweight move lower in live cattle is not as visually alarming as one may think when zooming out and looking at a longer-term chart. However, short-term damage to the charts has been done and a recovery will not happen overnight. So it will take some persuading from a few traders that view this as an opportunity to get long. Looking forward into coming months, as evidenced by the funds cutting back on their net long position, not just in cattle, but many ag commodities. Money flow warrants risk to the downside as recession fears preside over outside markets and funds look to transition into safer investments. Overall, technicals still favor the bull camp in the long term, but shorter-term technicals have dug a hole that they have yet to dig out. So we could easily see another flush lower before enough buyers are willing to step in. In fact, you zoom out on a long-term chart, feeders could have another $15 move lower from here and live cattle another 10 before long-term damage to the charts really even begin to come into play.
Trey, that was excellent insight and excellent information. Thank you very much, and congratulations again. That is a wrap for this episode of Pasture to Pen. Thank you to all of our viewers for watching this episode. If you have not done it yet, hit the like button, hit the subscribe button, and click the bell to be notified of future episodes. A big thank you to Paige, who always helps us look and sound our best. A big thank you and big welcome to Lexi, who will continue to help us sound and look smarter. A big thank you to Corey, Hattie, and the entire EverAg Insights team for making the show a reality. Until next time, stay safe, pray for rain.